In today's video, I will show you how to tell the difference between a liquidity grab and a trend change. What I'm about to show you will give you a probabilistic edge over the market. When I show you these patterns, you will be able to use them to understand the direction of the move and build high probability trading ideas. So, let's get into the video. We need to understand a few key elements required to grasp this concept. We have liquidity that is located above or below each individual high or low. We want to determine whether this liquidity is being used to sustain the trend or if it's being used to create new market orders. The price that breaks a high or a low can either show an intention to continue moving in that direction, or that high is being used to create a flow of market orders. Since we are tracking the activity of banks, we know that for them to sell, they first need to buy. This is why we will look for a manipulation, where the price moves above a high or below a low, which is followed by an aggressive move in the opposite direction. And the direction of the trend on the higher time frame will be the key to understanding whether a liquidity grab is occurring or if it's a trend break. Everything I'm going to show you is a scenario. It's a pattern that you can use to understand the market situation, and based on what I show you, you will be able to create repeatable patterns and use them to profit from the market. I'll tell you straight away, you won't learn this overnight. It took me a significant amount of time to understand this concept, but in the future, it will benefit you immensely, and you will get answers to all your questions. Put bluntly, this is like a vital piece in the field of trading, a foundation for understanding the overall picture. But overall, the market is probabilistic, and nothing can be certain. This is precisely why we have scenarios, not definite facts. Now, I want to introduce you to all the different patterns. We will talk about liquidity grabs, as well as trend changes, and how to identify them. Then we will move to the chart, and I will show you live examples of current price action. Now, if you look at the image, you will see that the price has moved above the previous high. Thus, we have witnessed market manipulation. Now we need to determine whether this is a liquidity grab, meant to see a continuation of the downward move, or if it's simply a structural breakout, meant to see a pullback and a continuation of the move in that direction. And one of the key questions you must ask yourself is, what is the direction of the trend on the higher time frame? Because if we have a bearish bias on the higher time frame, then this sweep should be a liquidity grab, meant to create new orders to continue the direction set by the higher time frame. And this would be a bearish liquidity grab. Now, if you look at the image, you can see that the trend is clearly bullish. We have a low, then a high, then another low, then a high. We have just reached the previous low. Now we need to understand, is this a trend break, and can we establish a new bearish trend? Or is this simply a liquidity grab to see a continuation of the move on the higher time frame, to see a resumption of the bullish trend? Once again, I repeat, the key question you must ask yourself is, what is the direction of the trend on the higher time frame? Because if we are bullish on the higher time frame, then this means new market orders are being created to continue the move on the higher time frame. Essentially, here we are seeing manipulation, and then we observe the beginning of the resumption of the move, the directional move on the higher time frame. And these 2 points I just showed you are the definitions of a liquidity grab. In general, it's important to understand the direction of the trend on the higher time frame to determine whether it's a liquidity grab or a trend break. Now, if you look at the screen again, you'll see the distinction between a liquidity grab and a trend continuation. We can see that a trend change has occurred, and we are now in a bearish trend. And this is precisely where you should look for a pullback and continuation to follow the trend. So now we can play this as the formation of a trend continuation. One of the key things you need to do is wait for the price to return to a premium position, so you can join this trend at a good price. And when you see these moves, the most important thing is not to try and jump ahead. You need to be patient and wait for this pullback. If the market doesn't pull back, you won't have a high probability of executing a trade, nor a good risk-to-reward ratio. If you look at the screen, we can see a bullish structure break happening here. And now, the most important thing about this structure break is where it is occurring on the chart. Here, you need to use all time frames together and understand where the points of interest are located on the higher time frames. So, what are points of interest? Well, these could be a simple order block from a higher time frame or an imbalance. Now we can look for our higher high and enter in the discount zone. If this happens not at our points of interest, but somewhere in the middle of the chart, we would consider such a structure as liquidity removal and would continue with the trend until we enter our zone of interest. If we have entered the zone of interest, the price has broken the trend, but you are afraid to enter or are unsure. It's better to wait for the price to make another high and then enter your position on the pullback. Now we will move to the chart and analyze the chart itself. We have a downward movement, but what did we notice? Here the price made a low, made a high, made another low. This high and this high then made a new low, and the price moves higher, meaning it might be breaking the trend here, or it might not. And how do we determine if the price has truly broken the trend, or if it is just removing liquidity and will continue downward? To answer this question, you ask yourself, are we in a zone of interest on the senior time frame? If yes, then it is highly likely to be a genuine break. If no, then it is not a break. It will be a removal of liquidity, and the price will continue its downward trend. Now, let's switch to the 4-hour chart and see where we are. Are we in a zone of interest or not? To do this, we mark this area and move to the left side of the chart. On the left side of the chart, we see that there is an imbalance here where the price is currently trading. If we look even more carefully, we will find another imbalance. We also have an order block, a true order block, that is removing liquidity. After the price removed liquidity and formed the order block, the price moved sharply upward, continuing our bullish trend. Accordingly, we have just answered the question, are we at a point of interest? No, we are not. Therefore, it is highly probable that the price will move lower, and that apparent break was not a genuine break, but simply a removal of liquidity. Now, we can move this entire zone to the right side of the chart. Let's use a different color and switch to the 15-minute time frame. We have just answered the question. This is most likely liquidity that the price will remove and then reverse. If this is liquidity, then our trend break will be right here. From this high to our low, we can draw a Fibonacci retracement. Above the 0.5 zone, in the premium zone, which is located here, within this range we can accumulate our position. We can place a stop loss, for example, beyond this high, and our target will be right here. Subsequently, we can observe that the price moved to remove liquidity from this low. It enters the imbalance and also enters our zone of interest. Now, within this zone, on any time frame, we can look for our trend break. Therefore, we can switch to the 5-minute time frame, for example, or even the 1 minute. It doesn't make much difference. So, here I already see a trend break on the 1-minute time frame, located right here. Here, we can again apply the same Fibonacci tool to identify our discount zone. We can also observe an imbalance in this zone, as well as the same order block that is removing liquidity. And here, without fear that the price will go lower because we are in a premium zone, a zone of interest, the price breaks the trend and subsequently moves upward. And where will it go? If we have already entered a zone of interest on the senior time frame, then accordingly, we should be looking for liquidity on that senior time frame. And the liquidity will be precisely this high. So, we see the price moving rapidly in our direction, removing liquidity from this high. And on the senior time frame, we can observe a trend break. Why? Because this high gave us a new low, and this low gave us a new high. Accordingly, we do the same thing. We are at a point of interest on the senior time frame, on the hourly chart. We have a trend break. We apply the same Fibonacci tool. In the zone below 0.5, we look for an order block or an imbalance. For example, on the hourly time frame, I don't see it. Let's switch to, for example, the 2-hour. On the 2-hour, I also don't see anything. Let's try the 3-hour, for instance. Well, in this zone, I already see some kind of imbalance. It's not large, but it's quite possible the price will reach here, reverse in this zone, and then proceed to remove the liquidity from these highs, for example. The first target, of course, will be the high of this candle, and subsequently, we see the price moved upward rapidly. As we can see, the entry process on the 1-minute, 5-minute, and 15-minute time frames is absolutely no different. The most important thing you must understand is that you must follow the senior time frame. This is, roughly speaking, the holy grail of trading. Always look at the direction on the senior time frame, and only when you have identified a zone of interest should you look for an entry point there.